Hi everyone, I am Dr. Purushottam DN, Assistant Professor of Commerce. Let us begin with the session for Become Third Semester course. Subject entitled Financial System and topic entitled Functions of Financial Intermediaries. A financial intermediary refers to an institution that acts as a middleman between two parties in order to facilitate a financial transaction. The institutions that are commonly referred to as financial intermediaries, including the commercial banks, investment banks, mutual funds, and pension funds. They relocate earned investment capital to productive sector of the economy through debt and equity. In simple terms, financial intermediaries channel funds from the individuals or corporate with the surplus capital to other individuals or corporations that require cash to carry out certain economic activities. Role of financial intermediaries. The reason for the all-pervasive nature of the financial intermediaries, like a bank and insurance companies, lies in their uniqueness. As outlined above, banks often serve as the intermediaries between those who have the resources and those who want resources. The financial intermediaries, like banks, are assets based or fee based on the kind of service they provide along with the nature of the clientele they handle. Asset-based financial intermediaries or institutions like bank and insurance companies, whereas fee-based financial intermediaries provide portfolio management and syndication services. Asset storage. A commercial bank provides safe storage for both cash as well as the precious metals such as gold and silver. Depositors or issue the deposit cards, deposit slips, checks and credit cards that they can use to access their funds. The bank also provides depositors with records with the withdrawals, deposits and direct payments they have authorized. They ensure the depositors' funds are safe. The Insurance Corporation of India requires deposit-taking financial intermediaries to ensure the funds deposited with them. Providing loans. Advancing the short-term and long-term loans is the core business of the financial intermediaries. They channel funds from depositors with surplus cash and individuals who are looking to borrow money. Borrowers typically take out loans to purchase capital-intensive assets such as business premises, automobiles, and factory equipments. Intermediaries advance loans at interest, some of which they pay the deposits whose funds have been used. The remaining amount of interest is retained as profit. Borrowers undergo screening to determine their creditworthiness and their ability to repay the loan. Investment. Some financial intermediaries such as mutual funds, investment banks employ in-house investment specialists who help clients grow their investments. The firms leverage their industry experience and dozens of investment portfolios to find the right investment that maximum returns and reduce risk. The type of investment range from the stock to real estate, treasury bills and financial derivatives. Sometimes intermediaries invest their clients' funds and pay them an annual interest for a pre-agreed period of time. Effort from the managing client funds. They also provide investment and financial advice to help them choose ideal investment. Financial intermediaries offer some advantages. Spreading risk. Financial intermediaries provide a platform where individuals with the surplus cash can spread their risk by lending to several people rather than to only one individual. Lending to just one person comes with the larger, higher level of risk. Depositing surplus funds with a financial intermediaries allows the institution to lend various screened borrowers. These reduces the risk of loss through default. The same risk reduction model applies to insurance companies. They collect premium, clients provide policy benefits if clients are affected by the unforeseeable events like accident, death, and diseases. Economic of scale. Financial intermediaries enjoy the economies of scale since they can take deposits from a large number of customers and lend money to multiple borrowers. The practice helps to reduce the overall operating costs that occur in their normal business routines. Unlike borrowing from individuals with inadequate funds to loan the requested amount. Financial institutions can often access large amount of liquid cash that they can loan to individual with strong credit rating. Economies of scope. Intermediaries often offer a range of specialized service to clients. These enables them to enhance their product to cater to requirement of different types of clients. For example, when commercial banks are lending out money, they can customize the loan package to suit small and large borrowers. Small and medium enterprise often make up the bulk borrowers. Preparing packages that suit their needs can help banks grow their customer base. Similarly, insurance companies enjoy the economies of scope in the offering the insurance packages. It allows them to enhance their products and services to satisfy the needs of the specific category of the customers, such as people are suffering from the chronic illness or senior citizens. Banks. A bank is a financial intermediary that is licensed to accept deposit from the public and create credit products for borrowings. Banks are highly regulated by the government. Due to the role they play in the economic stability, they are also subject to minimum capital requirement based on a set international standards known as basic currents. Credit unions. A credit union is a type of the bank that is a member only. It operates on the principle of helping the member success credit at a competitive rates, unlike bank credit union are established to serve their members and not necessarily for profit purpose. Credit unions claim to provide a wide variety of loans and saving product at a relatively lower price than other financial institutions offer. They are governed by a board of directors who are elected by the members. Mutual funds who savings from individual investors. They are managed by the funds who identify investments with the potential of earning a high rate of return and who allocate the shareholders fund to the various investments. These enables individual investors to benefit from the returns that they would not have earned and they invested independently. Financial advisors. A financial advisor is an intermediary who provides financial service to clients. In most countries, financial advisor must undergo the special training and obtain the license before they can offer the consultancy services. A financial intermediary performs the following functions. As I said before, the biggest function of the financial intermediary is to convert the savings into the investment. Intermediaries like commercial banks provide the storage facilities for cash and other liquid assets like precious metals. Giving short and long-term loans is a primary function of the financial intermediaries. These intermediaries accept the deposit from the entities with surplus cash and then loan and to entities in need of funds. Intermediaries given the loan at interest, part of which is given to the deposits while the balance is retained as a profit. Another major function of these intermediaries is to assist clients to grow their money via investment. Intermediaries like finance, mutual funds, investments banks use their experience to offer investment products to help their clients maximum returns and reduce risk. Advantages of financial intermediaries. They help in lower risk of the individual with the surplus cash by spreading the risk via lending to several people. Also they thoroughly screen the borrower, thus lowering the default risk. They help in saving the time and cost. Since the intermediaries deal with a large number of customers, they enjoy the economies of scale. Since they offer a large number of services, it helps them customize services for their clients. For instance, banks can customize the loans for small and long-term borrowers as per their specific needs. Similarly, insurance companies customize plans for all age groups. They accurate and process information, thus lowering the problem of a systematic information. Let us consider a simple example that will help us understand these advantages better. Suppose you need some money, but you don't know who has enough money to give you. So you contact middleman, who in turn is contact with those with surplus money. The financial intermediaries are as a crucial to the economy as the blood is to the body. Some of its significant benefits are discussed, namely low risk. The involvement of the intermediaries reduces the risk of the fraudulent default and capital loss for the lenders. Convenience. Exchange becomes suitable for the investors as well as the borrowers, since the parties do not need to invest time and money in searching for each other. Instead, they have to approach the intermediaries for the purpose. Economies of scale. The cost involved in the lending and borrowing of funds, like analyzing credit position, operational expenses, and cost of paperwork, decreases to a larger extent. The financial intermediaries perform such activities on a massive scale. Financial specialization. These organizations or companies specialize in fund management and investment activities, providing better returns to the investors and easy loans to the borrowers and greater liquidity. The financial intermediaries, like banks, investors, or depositors, to withdraw their amount at any point of time as per their requirement. Consider safe investment. For the investors' point of view, financial intermediaries are considered to be the more trustworthy and reliable than lending money directly to an individual interest. Thank you.